If you're just starting out in trading and you're struggling to build the momentum that you need in order to draw an income from it, or you may be wanting to build a strong enough track record so that you may be able to attract potential investors to invest capital with you, or you simply just want to invest some of your own money and grow it to a point where you can invest the proceeds in other projects or use it to go on a holiday or even as a down payment on a house, then today's video was made with you in mind. So it's not uncommon for people starting out in trading to focus all of their time and energy on perfecting a strategy or conducting fundamental research with the intention of getting an additional edge over the markets. And believe me, I am no exception to this rule. In fact, when I started out, I spent the bulk of my early years trying to understand and apply the economic and fundamental reports and the impacts that it may have on the currency markets, only to be left more confused than when I knew basic technical analysis. And it's safe to say that although I did learn a lot, I didn't necessarily see any of that information reflect in my returns. You see, I was trying to improve my knowledge about the markets in the hope that it would make me a better analyst and trader. However, it was at the latter part of my career when I realized that although I got a lot better as an analyst, I wasn't necessarily getting any better as a trader. And there's a very good reason for that. Hello and welcome. My name is Dean Miller from Wealth Tip, where our tip for wealth is to trade, invest, and prosper. And if you're new to this channel, then go ahead and click the subscribe button as well as the notification bell, and that way we can stay in contact and continue adding value as we journey alongside you on your way to success. Now, the path to trading success is filled with long and tedious detours, and if you aren't careful, you could find yourself going down a rabbit hole filled with outdated and untested methodologies that will push you further and further away from your trading goals and ambitions. In my experience, the best way to avoid these rabbit holes is to listen, follow, and study reputable and experienced traders that are willing to share the good, the bad, and the ugly parts of trading with you, ultimately leaving you to make an informed and calculated decision that's void of any unrealistic or over-optimistic expectations. Another way to avoid these rabbit holes is by not necessarily only learning how to analyze the financial markets, but also how to analyze your trades and its results. And it's for this reason that we put this very series together. You see, it's not necessarily only to equip you with the ability to analyze your trading results using the formulas that we give you, but it's also there to help you determine whether or not you have a profitable formula that has the potential to lead you to fulfill your trading goals and ambitions. And in today's episode, we're going to be looking at the statistical expectancy formula. So this formula is a performance metric that uses the win rate, the average win rate, the loss rate, and the average loss rate in order to determine the average profitability per trade, giving us the expected profit on average per trade for each trade that is made. And the formula is as follows. So it's open bracket win rate multiplied by average win rate, close bracket, minus open bracket loss rate multiplied by average loss rate, close bracket. So to see how this formula works, let's go back to Tom and have a look at what his expected profit on average looks like using this formula. Now, as you may already know, Tom has a win rate of just 20%, and his average win rate has been calculated to be $596.89. That being said, Tom also has a loss rate of 80%, and his average loss rate is calculated to be just $45.05. So if we were to put these figures into a formula, then it would be open bracket 0.20 multiplied by 596.89 close brackets minus open brackets 0.80 multiplied by 45.05 close brackets. And if we were to do the calculation, then as per the formula, Tom's expected profit average per trade would be $83.33, which is well above average for the type of trading system that he uses. And what this formula shows is that with an expectancy of $83.33 per trade, Tom can plot an expectancy along with the actual trades to verify his trading strategy remains valid. until Tom begins to see that his trade equity diverges from the actual trade line. He will then know that the market conditions has changed, and as a result, his strategy no longer is conducive to the new conditions of the market, and as a result, he will have to reevaluate his entire approach. This formula is particularly useful in the sense that it helps you determine if you have in fact a profitable formula. You need to include not only the win rate and the loss rate, the average win and loss rate, and the profit factor. You also need to add the expectancy and the number of trades in order to determine exactly how profitable you expect your trade plan to be over time. So, as you prepare to improve your knowledge about the markets and learn how to become a better analyst and trader, don't forget that to find success and consistency in trading, it requires you to not only analyze the markets, but it also requires you to analyze your results as well. So use these formulas to improve your results and achieve the goals and ambitions that you've set for yourself. Until next week, keep well and bye for now.